So we will continue our discussion on economy. We are in the module monetary system, and in the last session we have talked about monetary policy measures. We just started off with monetary policy measures, and I've told you there are different types of measures, monetary policy measures. We have started off with qualitative and quantitative methods. Okay, so quantitative measures and qualitative measures are there. Quantitative measures are general in nature, that CRR, SLR, okay, cash reserve ratio or statutory liquidity ratio. Okay, and then we have talked about, we will be talking today about reverse repo, MSF. All these concepts will be discussed. Bank rate, open market operation, all these comes under quantitative measures, and in qualitative measures certain other measures are also there that we'll be discussing in the next session. So yesterday or in the last session we have talked about cash reserve ratio. It is nothing but the percentage of NDTL, net demand time liability, that banks have to keep in the form of cash with RBI at any point of time. So banks have to keep certain amount with RBI at any point of time, and that is what CRR. Okay, so how CRR can be used as a monetary policy measure or to control money supply? If CRR is increased, what will happen? Money supply will decrease because banks have to keep more money with RBI. So what will happen? Banks will have less money to lend. So bank will lend less, so money supply will come down. Okay, so it will also affect the profitability of bank because less the lending, less the profit. More the lending, more the profit for bank, because the profit is all coming from the interest, and you get interest only if you lend. Okay, now money supply decreasing means what? Automatically it will affect the purchasing power. So purchasing power will come down, and I've told you when the purchasing power comes down, the aggregate demand will come down, aggregate demand will decrease. And when the demand decrease, in this way you can control the inflation. Okay, so in this way inflation can be controlled, but there is a big issue here that the growth will be affected. The growth will also come down. Okay, so this is what we have discussed in with respect to CRR. Now if you need to increase or boost the growth, CRR have to be reduced, so money supply will be increased, so aggregate demand will increase, so growth will increase. But the problem is inflation will also increase. Both go hand in hand. Okay, so you cannot achieve both of them simultaneously. Okay, and then we have discussed SLR, statutory liquidity ratio. It is a percentage of net demand time liability of the bank that have to be kept with themselves in the most liquid form, like in gold, cash or government securities. And I told you they won't prefer cash because there is no return. They won't prefer gold, even though gold will give you more return, but it will give you more return if it is calculated on the basis of market rate. But you know, to prevent import of gold. Otherwise, if gold is calculated on the basis of market rate, banks will keep this in terms of gold, and that will increase the imports, right? So it will be calculated on the basis of a constant price or a base price. Okay, so it won't give much return even if you keep it in the form of gold. So banks will prefer to keep the SLR in the form of government securities, and around 77% interest also you'll get some return. So banks prefer to keep this SLR or maintain this SLR in terms of government security. And I've told you one question which was asked before: which instrument of monetary policy compel the banks to lend to government? It is SLR. Otherwise banks won't prefer to buy government security. Bank will hardly get 6 to 7% interest. If bank lend outside, banks will get more interest. But when the SLR is increasing, banks have to compulsorily maintain it. So bank have no other option but to purchase the government security to maintain the SLR. So SLR is the instrument through which banks have to compulsorily lend to the government. Okay. Then today we will now how SLR is actually affecting the money supply. SLR increase means credit creation capacity of the bank will decrease because banks have less money to lend. Okay, so it will directly affect the money supply. So you can see money supply is coming down, purchasing power will come down, aggregate demand will come down, so you can tackle inflation. So to control inflation, what you need to do? You can increase SLR, you can increase CRR. Okay, when it comes to repo, reverse repo, I'll tell you the same thing only. Okay, we'll see that today itself. But the problem is growth actually came down. Now to stimulate growth, if that is the objective, then what RBI have to do? Decrease the SLR. Okay, so if the objective, it depends on the objective whether to boost the growth or to control the inflation, but the priority is given to inflation. Okay, so now we will discuss about bank rate. Bank rate. So first I'll write down what is this definition and then I'll explain this. Okay, so it is the rate of interest at which central bank lends to commercial banks. Okay, so this is the rate of interest at which central banks lend to commercial government, or this is the rate of interest at which commercial banks can borrow from central bank. Now there is a technical definition. I'll give you the technical definition also, and I'll explain what are the technical terms when we discuss about repo and reverse repo. So here it is the rate of interest at which central bank provides rediscounting facility I'll tell you what is rediscounting facility. Here itself I'll tell you, to commercial banks against their first class securities. I'll tell you what is first class securities also. First class securities. Okay, so just write down this definition and I'll explain this now. So we need to explain these two terms, rediscounting facility and this first class securities. Now what do you mean by first class securities? These are the private sector or non-government securities. See, we have already talked about government securities when we discussed about SLR. Banks have to maintain SLR in the form of government security or gold or cash, but banks prefer government security. Here I am talking about first class security. First class means private or non-government securities. Okay, so this is nothing but private or non-government securities. So what banks will do, just like banks buy the government securities, banks will also purchase some non-government securities, and now banks can pledge this non-government securities or this first class securities. Okay, and banks can borrow from the central bank, and in bank rate this first class securities is what actually pledged in the central bank. Now what are the examples? Commercial paper is an example, commercial bill is an example. Okay, so commercial paper, commercial bill, etc., or CP, commercial paper. What is commercial paper? These are unsecured securities, because it's a non-government securities or bonds issued by high net worth companies to banks against short-term loans. Okay, so when the private companies, high net worth private companies, there's a keyword, high net worth companies, when they need short-term working capital, so for this short-term loans they issue bonds or securities and banks will buy that. So that is what commercial paper, and this is what we call as discount. I'll show you what is this. So now I'll explain this what is rediscounting, right? I'll explain rediscounting, but before that I'll explain what is discounting, or I'll explain first how the banks buy bonds. Now this are issued for a minimum value of 25 lakhs at a discount. Okay, minimum value of 25 lakhs at a discount, and the maturity period vary from 14 days to 1 year. So there's a short term capital for the net worth companies. Now how it will happen? High net worth company. Okay, so they, let's say Wipro or TCS. Okay, so this company, high net worth company, they issue a bond or security or a commercial paper. Okay, so CP rupee 25 lakh and maturity 1 year to the bank. Okay, so the company issued security to the bank. Now what the banks will do, banks will give money. Okay, now if you remember when we discussed about government securities, I've told you even though the face value is 100 rupee, for let's say 100 rupee, banks won't be buying it at 100 rupee. Banks will be buying it at some lesser price, right? 93, 94, 95, etc. And I've told you the difference between the face value and the price at which the bond was bought is actually the return or the interest. So let's suppose if it was bought at 95 and the face value is 100, the interest is close to 5%. Here also, banks won't be giving 25 lakhs. Banks will give something less, and that's why we call it as discounting. Let's say banks give around 22.5 lakh, okay, to the bank. So this is what what is done. Banks purchase this 25 lakh bond for 22.5 rupee. That means at a discounted price. So this is what you call as discounting. So this is what you call as discounting. And what is the return for the bank here after the maturity? Let's say close to 10% is the return, 10-11% return is there. Okay, so I hope you understood here. 22.5 was lending, 2.5 was the profit or the return of the bank, close to 11% discount. Discount was there. That is actually the interest for bank for this particular loan. So it's actually a short-term working capital. Okay, so this is the most important source of big companies for the short-term working capital, and commercial bill in case of small companies, commercial paper in case of high net worth companies. So there is not different. The difference is this: it depends on the company. High net worth company, we call it as commercial paper. It's a small companies, it is a commercial bill. So there is a most important source of working capital, short-term working capital for this companies. Okay, so it's a kind of loan, and this discount is actually the interest. Now what the banks can do, banks can pledge the securities to the RBI. So now what RBI will do, RBI will deduct some interest and will give cash to the banks. Okay, so that process is known as rediscounting. I'll tell you what is rediscounting. So here this is done. Now this banks, what they do, banks can give this security to RBI. So RBI will do what? RBI will do the rediscounting. That means give loan against that security to the banks. Okay, so this process is known as rediscounting. Now let's say the current policy rate, the repo rate, if it is 4.45, okay, 4.45. So repo is 4.45. Now RBI only fixes a policy rate, and bank rate is 0.25% above that percentage point. Okay, let's suppose if it is 50 basis point, you have to add 50. If it is 25 basis point, you have to add 0.25. I'll talk about this percentage and percentage point differences later. Okay, so let's say 4.7 is the interest charged on, or the bank rate. Then here RBI will charge around 4.7 for this 25 lakh. So you can see here banks charging 10%, RBI charging close to 5%. So obviously RBI will be lending more than what banks were lending to the private company. So it will be close to 23 or 23.5 lakh. So this much, or even 24 lakhs also banks can borrow from RBI, because the interest is less here. When banks borrow at the bank rate from RBI, the interest is less. But when this discounting is done, interest is slightly more than that. So obviously banks will get more than what they have given to the company. So I hope you understood this. So this is what rediscounting, and this is what bank rate. So what is bank rate? It is a rate of interest at which central bank provides rediscounting facility to banks. That means banks can borrow from central bank by pledging the first class securities like commercial paper, commercial bill, etc. Okay, these are the securities of private or non-government entities. Now how will it affect the money supply? See, if bank rate is increasing, money supply, what will happen? Bank rate is increasing means it won't be easy for the banks to borrow from the RBI, right? So it will be difficult for banks to borrow, or the cost of borrowing will be more. When the cost of borrowing will be more, bank will borrow less. So automatically credit creation capacity of the banks will be less, money supply will be less. Now money supply is less means what will happen? The purchasing power will be less. Purchasing power will be less means, aggregate demand will be less. So what are the two outcomes? Inflation you can control, because demand you controlled, but you have to sacrifice on growth. So growth will also come down. So if the objective is to control inflation, what you will do, you increase the bank rate. Just like SLR and CRR, you increased and you control money supply, you controlled inflation. But if the objective is to boost or stimulate the growth, what you need to do, decrease the bank rate, just like in case of CRR and SLR, and pump more money so that more demand will be there, more production will be there, growth will be there. But both never go hand in hand. Okay, it is difficult. It cannot be achieved together. If there is a growth, there will be inflation because demand is there. Now see, when we discussed about the SLR and CRR, I have told you that it both will affect the profitability of bank, right? CRR increase means banks have less money to lend, so it affects the profitability of bank. SLR increase means still banks have less money to lend, it affects the profitability of bank. But compared to CRR, SLR is much better because for SLR you are getting some return in the form of interest because you are keeping it in terms of government security. But in case of CRR, you are just keeping the money idle with the RBI and you won't get any return. Now, which will affect the profitability more? If you compare all the three, bank rate will affect the profitability more because it directly connected, right? Because banks now cannot borrow from bank if the bank rate is increasing. So it is directly connected. The cost of this borrowing will be directly transferred to the customer. Okay, so borrowing of banks will be less from RBI, so lending also will be less. Rather, the burden will be transferred to the consumer or the customer. Next is the most important concept that here we'll be discussing about repo and reverse repo. So liquidity adjustment facility. Okay, LAF. So let me write down what is the definition. Under LAF, central bank seeks to reduce short-term fluctuations of liquidity, that means money supply, short-term fluctuations of liquidity, that is money supply, in the economy through repo and reverse repo transactions. Okay, so here we will be talking about repo transaction and reverse repo transaction, and automatically we will be talking about repo rate and reverse repo rate. So what is this liquidity adjustment facility, or this, what are these fluctuations means? Let's say it's like this. Let's take different time intervals, 1 2 3 4. Let's say T1, T2, T3, T4. So on the x-axis I'm going with time, and on the y-axis let me go for money supply. So let's see the fluctuations in money supply. So here let's say this is constant and this is decrease like this, okay, and this is going like this, and this is increase like this, okay, then it is going constant. So you can see here fluctuations, right? So here you can see high rates, highly growing. So what is happening here? Here what RBI need to do in the second one, T1 to T2, here what RBI need to do? So shortage you can see here. So what RBI need to do? RBI need to infuse money supply. Okay, so infuse money supply or infuse money. So for that what you need to do? RBI will use repo to give money, to pump money. Okay, to inject money in the market or economy. Repo transaction will be used. I'll explain what is repo. Now here what you can see, high money supply. So T3, T4, you can see here high money supply. So excess money supply, what RBI have to do? RBI have to suck out the money. So here reverse repo. Okay, I'll tell you what is repo and what is reverse repo in the next 5 minutes. Okay, so let's go for repo. Repo stands for repurchase. Okay, so repo stands for repurchase. So see repo operations. So under a repo transaction, central bank, I am writing the technical definition, otherwise you know what is repo. I'll explain the technical definition also. Repo means simply banks can borrow from RBI. Okay, so banks borrow from RBI, but how? By pledging what? Okay, this is what we are going to discuss. Bank rate also, bank borrow from RBI by pledging the first class securities, here by pledging the government securities. Okay, so we'll discuss that. under repo transaction, central bank purchases short-term G-Secs, government securities, from banks or financial institutions with an agreement to sell them back at a predetermined date. Okay, so what RBI will do? RBI purchases short-term government securities from banks. So RBI purchases government securities means RBI will give money to banks. Okay, so this is an instrument through which banks can borrow by pledging the short-term government securities. But there is a agreement to sell them back at a predetermined date. So after the fixed date, you have to sell it back. Okay, that means RBI have to give it back to the banks. So banks have to give that money in return to RBI with the interest. So here how will it go? RBI, okay, and banks. So first what transaction, now G-Sec is there in between, right? So this government security is what RBI is going to buy. So first from bank RBI will buy, right? RBI will buy, and RBI will give what? RBI will give money, okay, with an agreement. What is that agreement? To sell back. RBI will sell back, and banks will have to return money. Okay, so I hope you understood this. This is what the technical definition. So under repo, banks can borrow from RBI at a particular interest rate by pledging the government security. Repo and bank rate, the only difference is in bank rate it was first class securities, here it is government security. Now which one will be preferred by bank? See, here money supply will increase, right? Money supply will increase, and this interest charged on this is what you call as repo rate. So this transaction is known as repo transaction, repo operation. The interest charged is actually known as repo rate. I'll write down that it is a rate, repo rate. Repo rate, it is the rate of interest at which central bank or financial institutions for short term period of time borrow from RBI. The rate of interest at which central banks lend to banks or financial institutions for short term period. Okay, that interest is what you call as repo rate. Now repo rate increase means what will happen? Repo rate increasing means what? Banks cannot borrow much, right? Because the cost of borrowing will be more. So it will be transferred to the customers directly just in case of, bank rate. So repo rate increasing means credit creation capacity will come down. So repo rate increased means credit creation capacity will come down, money supply will come down, purchasing power will come down, aggregate demand will come down. So you can control the inflation, but you have to sacrifice the growth. Growth will also come down. So if the objective is to control inflation, you increase the repo rate. Just in case of SLR, CRR and bank rate, repo rate also increase. And if the objective is to stimulate the growth, decrease the repo rate. Okay, so if the inflation is stabilized or if it is stable, you can promote the growth, so you can reduce the repo rate, like in case of CRR, SLR and bank rate. So what is the difference between bank rate and repo rate? In bank rate it is first class securities, in repo rate it is government securities. Now repo rate and reverse repo rate are different. Generally, not reverse repo rate, obviously, repo rate and bank rates are different in the sense that, repo rate will be slightly less than bank rate. Okay, what is the reason? What is the logic? Why repo rate is slightly less than the bank rate? See, RBI will now fix only the policy rate, that is a repo rate. So let's say 4.45 plus 25 basis point is the bank rate. So this is repo plus 25 basis point. Before it was 50 basis point. Now it is 25 basis point. It can be changed at any point of time. When I'm recording, it is like this. So when it is aired, it may be different. So don't worry about these values. but understand RBI fixes only the repo rate or the policy rate. Bank rate will be slightly higher than that. Why it is higher? What is the logic? Because if both are equal, banks will prefer to borrow under which one? Banks will prefer to borrow under bank rate. Why? Because you are pledging the first class securities, but government securities is more secure and more safe. Okay, so better securities you are keeping with yourself and you are pledging the least secure security. So that is the reason why bank rate will be slightly higher and repo rate will be slightly lower. Secondly, when you are pledging under pledging the government security, it will also affect your SLR. Okay, see, SLR has to be managed in the form of government security, but when you are pledging that government security under repo, that SLR requirement will be compromised. So banks can borrow under repo rate only if you have enough government security. So first you have to meet the requirements under SLR, and if you have excess government security, then only you can borrow. If you don't have excess government security, you need to borrow under first class securities, because in SLR, if it is counted, it won't be used for repo rate. It cannot be used for repo transaction. Okay, so excess government securities can only be used for repo transaction. So there is also a disadvantage. So that is the reason why interest is slightly lower in case of repo rate, whereas the increase is slightly higher for bank rate because it is a private security. Okay, so I hope this is clear for all of you. Now see, if banks have extra government securities, banks prefer which borrowing, repo or bank rate borrowing? Bank prefer repo because the interest rate is actually less when it comes to repo. Okay, so that is all about repo transaction. We'll go for reverse repo. But before that, what is the difference between this percentage and percentage point, or the basis point that you're talking about? See, let's suppose we talked about let's say 4% as the CRR. Okay, so when I'm talking about 1%, okay, 1% means 1% of this 4. What is that? 0.04. So what will be the increase? 4.04. You understood? But when I'm talking about 1 percentage point, 1 percentage point means 100 basis point. So 100 basis point means it's actually 1%. So when I'm talking about 1 percentage point, it is going to be 5%. So that is the difference. So when I'm talking about 0.25, it is percentage point. Okay, not 0.25 percentage. Most of the people are telling just as percentage, but that won't be correct. It has to be percentage point. So 1 percentage point, when I say it is 100 basis point. Okay, so 0.25 percentage point means just add 0.25. I hope this is clear. So I can't say 0.25 percentage increase or decrease. I should say 0.25 percentage point. Then only I can write 4.25 if it is 4. If I say 0.25 percentage, then it will be very less, right? 0.25 percentage of 4. What is that? 1% of 4 is 0.04. So 0.25 percentage will be 0.01. So that will be 4.01, like that. So I hope this is clear for all of you. If it is 1%, it will be 4.01. If it is 4.04, if it is 1 percentage point, it is 5%. If it is 0.25%, it is 4.01 only. But if it is 0.25 percentage point, then only 4.25 you can say. So it has to be clear, percentage point, not percentage. Okay, let's go for reverse repo. Reverse repo. So let me write down the definition similar to the repo rate. It is opposite. You already know. See, repo rate, the banks can borrow. Now reverse repo, you might have learned or you might have studied, or some teachers some point of time might have told that RBI borrow from the banks. It might have told in the beginning to make you understand, or it is a reverse to tell that reverse, or just because the name was reverse, it was coming in that way. But do you think that RBI have any requirement or RBI need to borrow from the banks? RBI never want to borrow from the banks. So you can use two ways to explain reverse repo. In simple language, I'll tell you the technical definition, that is entirely different, just like what we have seen in case of repo. So technical definition I'll talk. But generally what you understood is RBI borrow from the banks are reverse repo. Banks borrow from RBI is the repo. So here reverse repo, I'll tell you two ways of understanding. One is just like I've told you now, RBI borrow from the banks. Second is there's a rate of interest at which banks can keep their money with RBI. So there are two ways in which you can express this. Either banks or RBI borrow from bank, or there's a rate of interest at which banks keep their money with the RBI. Which one is better? I prefer the second one because RBI don't want to borrow from banks. Okay, so when you understand, it is better if you can take it in this way rather than banks, RBI borrow from banks. But repo you can tell banks borrow from RBI. But in reverse repo, you can't say RBI borrow from banks. Okay. So let me write down the definition under this. Central bank or RBI sells short-term GSEC. Before it was buying short-term securities at an agreement that sell them back at a predetermined date. Here sell short-term securities with an agreement that buy it back after a particular date. Okay, sell short-term government securities to banks in an agreement to purchase them back at a predetermined rate and date. This rate is what you call as the reverse repo rate. Earlier rate is what you call as repo rate. So how will it go? Like before I have shown you RBI and then GSEC, okay, then banks. So RBI first sell, right? RBI sell, so banks will give money. When RBI is selling, bank will give rupee to RBI. So, or bank deposit rupee to with RBI, or it's like banks are buying from RBI. Banks are buying government security to RBI. That way also you can interpret with an agreement what RBI will buy it back. RBI will buy back and will return this money. Return the money. Just like you see here, as we have explained here. Earlier it was RBI buying with an agreement to sell them back. Okay, here selling with an agreement with buying back. Now what will happen if reverse repo is increasing? Reverse repo is increasing. Reverse repo increase. The rate at which this transaction has happened is what you call as reverse repo. I am not writing this. Okay, so reverse repo increasing means what will happen? Banks will buy government security. So banks will keep money with RBI. So banks, money in the hands of banks is less, right? So automatically credit creation capacity of the banks will come down. So money supply will come down. Because banks have less money to lend now, money supply will come down. So what will happen? Purchasing power in the economy will come down. Aggregate demand will come down. So in that way you can control inflation. So you can control inflation, but what will happen? Growth will be compromised. So if the objective is to control inflation, increase reverse repo. Just like what we have discussed in case of SLR, CRR, bank rate, repo rate, reverse repo also increase. So you see repo and reverse repo both are entirely opposite concepts, but both will be done in the same way. Repo and reverse repo both have to be increased to control inflation. Repo increase means bank will be affecting the credit creation capacity of banks in a different way. Here also, because banks cannot borrow. Here, if the interest is increasing means banks keep automatically with RBI. Then also banks' credit creation capacity will come down. So I hope this is clear. All rates will be increased if the objective is to control inflation. All rates will be reduced if the objective is to boost growth, so that money supply will be increased. So it all connected with money supply. If need to increase money supply, you decrease the rates. If you need to decrease the money supply, increase the rates. So simple. Now reverse repo will be less or more than the repo. Reverse repo will be always less. Okay, so reverse repo will be always less, and it is 0.25 basis point less. So RBI now fixes only policy rate. So policy rate, let's say PR, plus 0.25 basis point is your bank rate. Okay, so what about reverse repo rate? It is policy rate minus 0.25 percentage point. Now why it is less and why it is more? Why bank rate is more? I've told you, because it is first class securities. Why this is less? The reason is, see, this is the rate at which RBI give you, or RBI is you are keeping money with RBI, right? Now imagine this case. If repo rate is less, I'm just talking about reverse repo and repo. If repo is less, under repo you can borrow from RBI, and under reverse repo you can give it to RBI. So let's suppose 5% is repo and 6% is reverse repo. You will borrow at 5% and you will give at 6%. So you only keep on doing that. Just like if you can get a bank loan at 4%, will you ever get it? You will never get it. But suppose you get it at 4% and banks offer you an interest of 6%. What you will do? You will get the money from the bank and you will deposit in the bank. You just need to do that only, right? So that is a simple logic. So I hope this is clear for all of you. If you missed out any of the session, join the Telegram channel. Next session we'll be talking about marginal standing facility connected to this. Now I don't have time. We'll complete that and then we'll go for qualitative measures. Join the Telegram channel. Get in touch with me in this Instagram ID if you need any mentorship or any doubts related to any sessions. Okay, so see you guys.